and welcome you to the chapter number 11, which is accounting for leases. Accounting for leases is basically a standard which is name is IFRS 16. So IFRS 16 is quite latest accounting standard. Before this accounting standard, we have International Accounting Standard number 17 who deal with leases. So when I was doing bachelor, my accounting standard was 17, and there were certain changes which I read recently as compared to this accounting standard compared to like 5-year or 10-year back accounting standards. So first of all, how this accounting standard is built, this accounting standard, the foundation of this accounting standard is the prior accounting standards and different SICs which will deal in this IFRS 16. So throughout this lecture, we will discuss like how this accounting standard is any different than the prior one. What was the entry system in this one, and what was the entry system in the prior accounting standard? So let's get started with. Number one is the objective of the study. The objective of this lecture is to try to understand like what is lease, what is leasee, what is lessor, what is the lease period. So all these concepts will be a foundation for us to solve any question. And by the end of this lecture, you will be able to prepare a lease schedule by your end. Whether it will be for lessee or it will be lessor, it depends on the situation. So the first is the definition. The definition say, what is a lease? Lease is basically a contract between two parties. One is lessor, the person who is giving the asset. Another one is lessee, who is receiving the asset. So the ownership of the asset changes during the period of the lease from the lessor to the lessee. So what lessee do when he receives the asset, he will start making the payments. Payments can be monthly, quarterly, or annually, depending on the contract these two parties have. For example, there is a contract between party A and party B. Party A say, I will provide you the asset, and you will have a full control of the asset. You can use this asset for 5 years or 4 years. In return, B say, hey, in return, I will provide you the money, the installment. So in this case, the person who is giving the asset is the lessor, and the person who is receiving the asset and making a payment is lessee. For example, this period is a 5-year period. So that period is called lease period. According to this new accounting standard, they say when the asset is transferred from A to B and B start making the payment, so it means he has a full control of the asset. So it does not matter he buy the asset from A or not. Just a control itself is sufficient to consider in the books of account of a B as an asset. So buying doesn't require in the contract of lease. So maybe after 5 years of lease period, the lessee, Mr. B, will have to return back the asset to A. So it's not necessary that B will keep this asset forever. Next, they talk about the different terms. I hope you can read this, and you can discuss about what is a lessor and what is a lessee and what is the definition, which I already described earlier. So this is a new accounting standard issues. They say, hey, since we have the control of the asset by the lessee, we need to, because there is a past transaction that has been happened, there is a sign of contract, and this asset will provide economic benefit to the company. So it fulfills all the criteria for describing anything like an asset. So therefore, accounting treatment for this one, for the lessee, is that once the contract has been entered, he will have to recognize it as an asset, at least for the time of the lease period. And then they talk about, hey, one time it will be asset. So the entry will be, they are buying the asset and the amount will be payable. So there will be a liability as well. So the lessee has to make a payment to the lessor in this case. So description of the obligation is given. There's a present obligation to pay. Last event has been done. There will be outflow of the economic benefit. So they should be a liability. So in the end, it will cause a liability, and on one end, it will be an asset. So the entry will be asset to the liability. That will be the entry for the moment this contract has been signed between the lessor and the lessee. So what is the different changes in this accounting standard, that is IFRS 16? In Australia, that is called IASB 16. So whether it's the International Accounting Standard Board, in Australia, that is Australian Accounting Standard Board 16, what they say about this? They say it does not matter what kind of a lease it is, you have to recognize all the lease like an asset. Anything you buy will become under asset. So why this point arise over here? Because before that, it was not the case. Why this discussion is like this? Because before that, it was not the case. So once there is a contract between lessor and lessee has been done, the prior accounting standard, International Accounting Standard number 17, say the lease can be of two types. One is operational lease and other is a financial lease. We will discuss in the later on slides what's the difference between these two types of lease. But for the point of lessee, there is no difference. Both is a lease. In both cases, they have to recognize any asset which they get during the contract of a lease. However, there are a couple of exemptions for this general contract. Number one is that if the contract is less than 12 months, means less than a year, so in this period, they will not recognize it as an asset. Another is the value of the asset is too low, means like you buy a mobile phone on lease or a laptop or something less than maybe, there is no specific amount, less than maybe like 5,000 Aussie dollar. So that's less than that will be considered as, cannot be considered as a lease agreement. It's more like an expense for the year. Of course, we will come down to this and we do all the general entries for that as well. So there's a little bit more discussion about what is the difference between the new accounting standard and the old accounting standard. You can read this slide. I like to move further because we will practically do the difference between these two in the upcoming slides. This slide requires some consideration to see. Here they discuss about like if there is a contract between lessor and lessee, and a contract start on this point. After the contract has been signed, after 1 year, they have to make a payment. The first payment by the lessee, second payment by the lessee, third, fourth, fifth. And maybe on the sixth payment, they also have to pay something extra money. So it may possible that after 5 or 6 years, the agreement is that they have to return back the asset. So at the end of the lease term, what will be the amount that the lessee has to pay? So first of all is the last fixed payment. So these are all fixed payments that he has to pay throughout the leasing period, throughout the lease period. Apart from that, there will be a guaranteed residual. What is a guaranteed residual is that, for example, the asset value is 100,000 at the commencement of the year. And they sign a contract that, hey, after 5 years, you have to return me that asset. For each year, you need to pay me, you can say 15,000. So for 5 years, they need to pay for this amount for the consecutive 5 years, starting from the year 1, 2, 3, 4, 5. So after 5 years, it will be around 360, 75,000. So the asset value is 100,000 when the contract of the lease has been signed. The lessee make a payment for 5 years for 5 different installments. And after making this installment for 5 years, they use it and they have to return it back. But at the time they make a guarantee that whatever the residual amount is the difference between the fair market value of this asset and whatever you have paid me so far. For example, the fair market value at the year 5 will be 80,000. So the difference between 75,000, which has been paid as an installment, and the fair market value of the asset by the end of the year, by the end of the lease period. is 80,000. So you have to pay you have to make a guarantee to write a residual amount. You have to make a residual payment for the asset to be shipped honor to you. So if there is a difference between the fair market value and the installment they have paid, it will be guaranteed that the remaining amount will be paid, which will be the residual. And the last term that you use is a price of the bargain purchase option. What is a bargain purchase option? Bargain purchase option that, okay, they pay for 5 years for 15,000 each every year. At the end of the year, they already fix the amount. Hey, after the lease period is done, you have to pay me 10,000 US dollar as a bargain purchase option. Means the lessee has the right or the option to purchase this asset and retain this asset forever or until whenever they want to use, if they pay this additional 10,000 by the end of the lease period. So we are not known what will be the fair market value after the 5 years, but we know that this contract between the lessor and lessee has been done. And after this contract has been expired, the lessee has to pay 10,000 extra and can buy or purchase the asset. So in the detail of this slide, you can see they write the word of if any. So maybe there is a term that after the lease period, you can have the asset back for 10,000, or maybe there is no term given for this amount. So it depends on you, it depends on the contract. So if the contract is different, and contract don't say anything, maybe they have a guarantee residual amount. But guarantee residual amount does not mean that the lessee has to buy back the asset. Whereas the bargain purchase option indicates that the lessee has the right to buy back the asset. And normally this will happen because it's already given in the contract. So if the price of the bargain purchase option is given in the question, we have to assume that the asset has to be remain with the lessee, not with the lessor. Whereas the guarantee residual is given in the question does not ensure that the asset will remain with whom. It can be with lessor, it can be with lessee, it can be have to return back. And most of the cases, it return back to the lessor. So lease is basically a contract between these two parties to use a certain asset for a time being. In return, they make a payment based on the annual period or the monthly period of the contract given. So this diagram or this picture will give you an overall view what we're going to do in this chapter. Okay, they talk about a little bit lease period. I will upload the slides, you can have a look. Let's start our first question. Say there is a Mini Limited who enter in a 4-year lease contract of a machine. So Mini will pay the fixed annual payment for 100,000 for 4 years, with the first payment to be paid in the next year. So you enter the contract in 2018. You need to make a payment in 2019. To enter the lease, Mini they incurred some direct costs and some indirect costs. Some of the indirect costs will be like $10,000 at the start of the contract. What that means? It means that maybe they have to pay for the lawyer fees to make this contract happen. They have to incur some direct costs in the contract. So we will see, apart from the annual fees, what will be the treatment for the direct costs. Now, there is a term which is given that there is a bargain purchase option that will be definitely exercised by Mini for 25,000 at the end of the lease period. So what that means that after this lease period is over, and this lease period is for 4 years. After the 4 year has been done, every year they pay 10,000 each. At the end, they will pay 25,000 extra to buy the asset forever, not to lease it, to buy it after the 4 years or 3 years. The machine is expected to have a useful life of a 10 year with no residual value. Residual value over here means scrap value. Means after 10 years, it will be completely zero. There will be no scrap value. So these are the few things which is given in the question. Another further information is given that the increment borrowing rate is 6%. The annuity amount is 6%, which is convertible into 3.465. You can see the table it is given, but actually no need to see the table nowadays. If you give the N and if you give the amount of interest, the Excel can easily find you what will be the present value to be multiplied. Another present value is a 6% for a 4-year period, that is 0.721. So those students who is not having accounting and finance background, the question is very simple, but in order to explain this question, I have to go back to the last slide. In this question, they say, hey, you need to measure what is the cost the moment you enter the contract on the date of the commencement. Okay. So every year they are paying 10,000 each, 10,000 each, 10,000 each, 10,000 each, 10,000 each. Every year they are being paid 10,000 each. Now, in finance, there is a concept called time value of money. What is the time value of money? Time value of money means the money you have in your pocket right now, its value will not be same as the time passes. You know, our economy can be hit by the inflation, COVID, exchange rate to the dollar, and many other factors influence the economy. So as well as it will change the time value of the money. So the money you have today, like 10,000 as if today, will not be the same value after the 4-year of contract. Like after 4 years, they pay 10,000. So its value will not be the same. So these are all future values, which is given after 1 year, 2 year, 3 year, and this is a 4-year contract. So every year you are receiving 10,000 from the person, from the lessee. So now we need to calculate the present value of all these future cash flows. So we need to see if I receive this money today as compared to upcoming 4 year or 3 year, like today, all of the future cash flows are given. What will be the value of that 10,000 in the future? So for that one, they have the concept of a present value formula. So present value is basically can be determined by the future value. The future cash flows are given, you can determine the present value if they give you a proper rate of return or the interest rate. In this case, they have given a present value for, in this case, for 6%. The present value was 0.721. And there is one more concept which added up, which is NAT. NAT concept is that if there is a constant cash inflows coming up for 4 year, for 5 year, so what will be the interest rate? So it is same like calculating the present value, but the installment which you receive in between is constant. Like in this case, the 10,000 you are receiving for 4 years is constant, so you can determine the annuity value or the present value of this annuity 10,000 every year. So this is a question, and the answer is in the next one. The requirement is determine the initial payment of the lease liability and the right of use of the asset and prepare the related accounting journal entries. So first we see what is the schedule we have here. So here our contract began. After 1 year, we pay 10,000, 10,000, sorry, 100,000 on 10,000, 100,000, 100,000, 100,000. And we are also having the purchase bargain option, which we utilize by the mini enterprise. So 100,000, 100,000, 100,000, 100,000, and an additional of 25,000. Now we need to determine the present value of this future cash flows. Like what will be the value of this 100,000 today, like this one, like this one, and like this one. So we need to calculate the present value of all these future cash inflow. We in accounting and finance time, we call it, we need to discount these future cash flows. So there is a rate which is already given. You multiply this rate with the future cash flows, and you will get the present value of this all future cash flows. Now the question arises, why I need to have a present value of this all future cash inflows? We need a present value of all these future cash inflows because we need to make an entry in our books of account today for lessor and for lessee. So we need to understand what will be the future, the present value of this all future cash inflows. Now, let me move further. The value of 100,000 is given, which is the annual payment for the 4 year. Here, we do not need to multiply by the 4 and times the value because the annuity value is given. Annuity value is a value in finance, which is we use for determining the present value of the future cash flows, which has a constant payment. Like in this case, if you see if the number of year is 4 and the present, the amount of factor is already given, annuity value is given, so you just need to multiply it. So here you don't need to look for any table schedule, although the schedule and table is already provided in the Moodle, but in Excel you can easily do that. So 100,000 is given, annuity value is given, so present value of this future cash flows is 346,510. Another is $25,000. This $25,000 is the money which a lessee has to pay by the end of the 4 year because he wants to purchase the asset. So once the lessee has to pay, the amount of 0.792 is already given, which is there to determine the present value of this amount. And this will be the total amount, 19,802. So 19,802 plus 346,510, the total amount of the lessee liability will be 366,312. So this will be the total in US dollar. That is the present value calculation for any future inflows, outflows or inflows. So here we do for two things. One is for the lease payment, another is for the purchase option. If we move further, we try to understand the cost concept. The cost concept includes whatever you have to pay as a lease payment, what is the direct initial cost, some of the estimate of the cost, that is dismantling the cost or removing the asset from its financial position. So for example, you have a plant and machinery, you buy this asset and you install that machinery. You know, after the lease period, like after 4 years, you have to dismantle the machinery and send it back to the seller. So that cost will also be the part of this one. So what's the difference between the liability and the cost, right of use asset cost? Liability is the amount on which the installment and that purchase option can happen. Whereas the lessee will record the asset on the liability plus some direct cost. So if there's some additional direct costs happen, that will not be a part of a liability. The reason is that because for this all amount, like any direct cost, you will already pay them in cash. So direct costs no need to be a part of the liability because it is to be incurred on the same year when they purchase it, and it need to be recorded as an expense on that particular. So this cost will be added in the direct cost and it becomes the total cost of the asset. So it will be capitalized in the cost of the asset. However, it will not be considered as a liability because it's not payable. We are paying in cash the moment we are buying this asset. Now, in our case, we already calculated the present value of all the future outflows. So the first is the lease machine. So first of all, whenever we buy an asset on lease, we name it like lease machine, plant, equipment, whatever we buy, that will be debit. We will credit the lease liability, that is 366,312. That's a present value of all the future cash inflows. And then we pay another 10,000 additional for the direct costs. So in order to recognize an asset, it will include all the amount of the lease, the liability amount, plus the direct cost. That will be the cost of the asset. or what we call the right of use, or the cost of the right of use we have over here. So in order to determine the value for the asset include liability of the lease plus direct cost. Any direct cost incurred in order to bring that asset or dismantle that asset, or the cost in our case was 10,000 they pay for the lawyer or for any legal fees. So that will be included in the part of the cost of the asset. Now, moving further, in this question, they say, hey, now we have calculated the present value, we have calculated how the entry system will work. Now, every year we need to make an installment. That installment is 100,000. But they do not tell us in 100,000 how much is the interest and how much is the principal amount. What is the interest and what is the principal amount? Principal amount is the amount which we pay for that cost of the asset. Interest is an additional load which we have to bear on taking the asset on lease. So here in the question, they provide you an additional 6% of the interest expense, which will be applied on the present value of the cost, present value of the liability. And for the first year, you have to pay an interest of 21,970. This interest will be part of the profit loss account later on. So first say you pay 100,000 and you know 21,000 is 979 is the interest. So actually the principal amount will be 78,021 US dollar. So the formula for the principal amount is the total payment or installment less interest amount. So there is something discussion about the subsequent measuring and how we have to apply the amortization on the lease asset. So lease asset needs to be amortized. Amortization formula is simple, whatever the present value of asset divided by. Now there is a discussion whether it will be a useful life or it should be a lease term, a lease period. So what it should be, lease or the useful life. So this discussion is given in this slide. They say, hey, whenever you buy an asset, you have to amortize that one. Just like you buy any asset, you have to depreciate that. So what is the discussion over here in the denominator section? They say if the lessee will purchase the asset after the lease period and retain the asset. So if he retained the asset, we will use the useful life as a denominator in order to determine the amortization. However, after the lease period, if the lessee do not retain the asset, we will use a lease term as our denominator for amortizing the asset. Because for example, in this question, they have the asset for 4 years. Maybe after 4 years, they will return back the asset. If they return back the asset, then we need to amortize this asset. We can only amortize this asset only for the lease period, because after the lease period, this asset will no longer be the property of lessee. So we can say that there is always a rule that the lease term is always less than the useful life of an asset. And which is quite obvious. Maybe the asset is having a 10-year or 20-year life, and the lease period is only for 5 years or 3 years. And then afterwards, they have to reutilize that asset later on. So the concept in this slide is very clear. We need to amortize the asset. But in order to determine the denominator, we have to see whether the lessee has to retain the asset. They retain the asset, then it will be the useful life of asset as a denominator. When the lessee do not retain the asset, then it will be the lease period as a denominator, lease term as a denominator of asset. So this point I'm clarifying here a couple of times, because in upcoming slides, there will be a calculation related to that part. Now this is our lease period, which is already given. So lease schedule is the ultimate goal for this lecture. My student, you should know how to prepare a lease schedule. If I provide you with a few things like the present value is given already, the interest rate is given, principal amount, for example, if this is the lease payment A, interest is B, then principal will C will be is equal to A minus B. That is as much simple as that. So we calculate the present value of the liability of the asset. Now we know every year he's charging us a 6% as interest. So we are applying 6% on that, and we are getting an amount of 21,970. Every year we are paying 100,000, apart from the last year, because last year is 100,000 plus 25,000 extra for the purchase back of that asset. So here is 21,000 as amount, and the remaining is the principal amount, that is 78,000. So there is a reduction in the liability, and after the reduction, it will remain 288,291. Same, we apply 6% here, and there will be another principal amount that they will calculate every year. So you can see every year the present value is reducing until it becomes 0. So you have no liability will be lost. So in the last, you have to pay a liability of installment of 125, where again the 12%, 6% will be the installment amount, and there will be a reduction in the principal amount, and remaining will be 0. So this is how a lease schedule is prepared. I will encourage all of you to prepare at least one lease schedule before coming to the tutorials. Now the entry system. The entry for the interest will be, of course, interest is expense, and the lease liability will be the liability for the year. Like in this case, we have the principal amount which we pay will be reduce our lease liability, which we credit in the last entries. Now we are debiting it, and we pay a cash of 100,000. So this entry we will keep on doing with a different change of amounts, but every year. Then for the amortization. Here the amortization, the amount is given 37,631, which is basically the present value, which is the asset value is asset value, which includes the double cost as well. 1 second. Yes, the asset value is 376,312. 376,312. The useful life of the asset is 10 years. Why we are dividing by the useful life, not by the 4, which is the lease term, is because in this contract, the lease asset has to be returned back to lessee. So the amortization for this asset will be 37,631, which is given here. So just a quick recall that the only denominator for the amortization depends on what type of a contract there is happening in between these two parties. Whether or not they are having a contract where there's asset who has to return back, or that asset has to go back to lessor or retain with the lessee. If you retain with the lessee, then useful life will be denominator. If you go back to the lessor, then the lease term will be the amortization, way of determining the amortization. That's pretty much it from illustration number 1. Now we move to the illustration number 2. So there are some new concepts which will happen throughout the accounting standard, which was not there in the last International Accounting Standard number 17, but IFRS 16 has indulged this some new implication for the accounting standard. They say, hey, this standard will apply to some of the organization who has the lease assets and the lease liability. And then they give the example of what are those. Now we discuss by the end of the chapter what is the lease agreement for the manufacturer, retailer, which was not there in the last accounting standard. Then they talk about when there is an increase in the reported rates and the asset, it will increase the accounting, the reported leverage. So it has implication on the leverage eventually. It will determine what will be the structure for debt and equity of a company. It will apply to different accounting methods. Yeah, that's one of the things. So yeah, you can read this where this accounting standard has been applied. I move to the next question, not next question, a few examples. We discussed earlier, if the asset is less than 12 months, then if the contract is of less than 12 months, then we do not consider that as a lease. So the question arises, then what we consider it? Okay, in this illustration number 2, we discuss about if the contract of lease is less than 12 months, means less than a year, so it's not considered as a lease contract. However, it will be considered as expense during the year, as I discussed earlier. So what will be the journal entry? So there is a discussion like if there is an asset you buy during the lease and its amount is less than, its amount is 20,000 and it is less than for 8 months or it's less than a year. So we will charge them as an expense. And for example, we are paying for that lease expense. So it will be go eventually to profit loss to the cash. So that will not create any lease liability or lease asset or any amortization or any schedule. Just a simple entry which we'll discuss that it is less than 8 months. So we just need to pass one entry. Then some further issues discussed on the lease contract, that the issue of the asset often include association services. So if there is a services render or something, then what we need to do. The service component is not treated as a part of a lease. Why is that so? The customer might sign a contract to the lease, but will never enter into the lease of the car. So these are the few services which is provided at service sector. So I will encourage you to read this one. This is more about for the knowledge sake of a student. There is a more discussion on the initial measurement. So whenever you have an asset, you not only have lease payment only, which is every year. You also have a very detailed, comprehensive residual income, and the amount can be guaranteed and be non-guaranteed. Then you also have that bargain purchase option. So these are the few costs that might incurred during the time of lease period. And apart from that, there is always plenty. If you do not pay any lease payment on the time, that will be part of a lease. Then a price to purchase option, which I already discussed, we solved the question. Amount expected to be payable by the lessee under the residual value, which is guaranteed, like after 4 years of lease, in the last person, he has to pay 25,000 extra. Then the last question I discussed that after the 4 years of lease, maybe the fair market value of the asset is more than what is there in the books, and the lessee has to pay for the residual value. Another is depending on the interest rate which he has to pay, which is a part of the contract. Then there's a fixed and variable payments which will happen throughout the year. Now, there is some discussion about the guaranteed residual value and non-guaranteed residual value. So, what is a non-guaranteed residual value? So we already discussed about the guaranteed residual value. So guaranteed residual value is a residual value of our asset, which is the difference between the fair market value of that share and the amount which is already been paid by the lessee during the lease period in terms of the installment. So unguaranteed is a part of it. For example, if there is any indirect cost or the cost incurred which we have not accounted for earlier, which has not been guaranteed earlier, will also be a part of this lease contract. I think there's a question in the upcoming slides discussing about this. I think this is one, but let's see. So very interesting question. In this question, they discuss about the date of entering the lease is 2019. Duration of 10-year lease is 10 years. Life of asset is 11 years, 1 year extra than the lease period. Then they have an ungranted residual value, which is 2,000. That's another cost which has been incurred at the end of the period. The lease payment, at the start, they have to pay $4,000 for the first year. For the subsequent year, is $35,000 for the next upcoming year. Fair value of the asset at the date of the lease inception means at the start is $26,000. So what you need to determine is to calculate the interest rate. So interest rate is an issue over here to calculate. Very interesting question. So all the details are given, but interest rate is to be calculated. So how to solve this question? So in this question, we will match the fair value of the asset with the fair value of this value, the present value of this all cash outflows. and see if these two are similar. So if they are similar, we can assume that the rate they have used to determine the interest rate is the similar one which is here. So because this rate or the fair value of all these assets has come up after they have discounted them to the present value. So if we have a cash outflow and we discount that as the present value, and their values are equal to 26,277, it means the rate we are using is similar like the interest rate of other assets. So the question starts with what is the future cash inflow? So first year we are paying them 4,000 ringgit at the start of the period. So this is very beginning on the day first, we have to pay them 4,000. For the next 10 subsequent year, we are paying them 3,500 every year for next 10 years. And then after the 10 year, we are paying them ungranted residual value, which is 2,000 ringgit, 2,000 US dollar. So we take a present value of this one, we take a present value of these two, and then we discuss how we discount them. If our value has matched with the value of here, then we discount them at the rate of 10%. So therefore, the 10% is rate of return, or the rate of the interest. So how do I take the present value of this and this? So I try to understand this question, but I cannot find out any slide. So I prepare my own working. So in my own working, what I do, I take the 2,000, which is ungranted residual payment. I take the 10% rate for the time being. I say and we already know it is for the 10 years. So this is the number of years. And in Excel, you can apply a formula of PV. So PV means present value equal to present value. And at the start, they ask you what is the rate, I think. Then they ask you what is the years, then double comma, and then you can put the future value. You can easily get the present value of that. Do try that on Excel. You need to learn this skill. This is very much important for the industry as well. You don't need to see those schedule manually to find out the rate. So another is for the 10 years. So here I write the years, 1 to 10. I assume the rate of interest is 10. I calculate the present value for each year, and then I sum them all. It was 21,506 ringgit, you can say $6. And I add this over on the top. So total amount will be 26,277, which is the answer which is already given as the present value of this asset. So in this way, what we did, we try to understand that we can calculate the rate of return or the interest rate also if the present value is given. So here in this question, they do not ask you what is the present value of the initial payment. The present value of the initial payment was already given, which is 26,277. It's already given. So what we do, we calculate our present value based on the interest rate, which in this case, we take the 10% hypothetically, which match with the exact rate, which match with the present value of this whole first lease installment, the fair value of the asset of the lease. So this is how we solve this question. The question was a little bit more trickier, so that's why I used Excel. I hope you no need to use Excel. Pretty much it from this lecture. I will discuss further more in the upcoming slides. So stay tuned. See you in the next video.